All right, let's dive in. Today, we're going to unpack the SDDS tax planning framework from Perpetual CPA. Now, this is a really powerful proprietary system they've developed to help make sense of tax strategy. We're going to explore how lawful tax strategies actually work, how you can evaluate planning opportunities, and, the really important trade-offs you have to consider along the way.
So to kick things off, what are we really talking about when we say tax planning? Well, the first thing you have to get is that tax planning is always administered at the household level. It doesn't matter if you file as a single person or as a married couple, the end goal is always to optimize your total after-tax outcome across all of your income sources. Business entities, you see, they're just tools within that bigger household plan. The strategies for a business definitely affect the household's bottom line, but they never operate in a vacuum.
Okay, so here's our game plan for today. First, we're going to look at the overall framework for planning. Then we'll get into the 4 core strategies: spend, donate, defer, and shift. And to wrap things up, we'll go over some essential guiding principles and, of course, a quick disclaimer.
All right, let's get right into it with our first section, the framework for planning. This is all about the process behind the plan, and it all starts with what you've already done.
So the tax planning process always begins by looking at your most recently filed tax returns, both for your business and for you individually. These documents give us a solid baseline, which lets us create an initial projection. From there, we have to make certain assumptions because, let's face it, a lot of these strategies require you to take specific actions. Once you decide to move forward on a plan, we then refine those assumptions based on your specific goals, your timelines, and your actual business plans.
And this is a really important point. Tax planning isn't just about analyzing numbers on a spreadsheet. It's really all about implementation, documentation, and follow-through. And what's really interesting is that almost every tax planning strategy out there can be bucketed into one of 4 key areas, and that's what makes up the SDDS framework. You can think of these as the fundamental levers the tax code gives you to manage your tax liability.
Let's see how this framework builds out, starting with our first category, the spend strategy. This is pretty straightforward. It's all about using your business or personal funds to pay for expenses that are deductible. Now, these expenses absolutely reduce your taxable income, but they don't actually generate profit on their own.
And you're probably already familiar with a lot of these. We're talking about things like employee benefits, think health insurance, contributions to retirement plans, all of your ordinary and necessary business expenses, and even certain capital expenditures and depreciation elections. That's really just a fancy way of saying you get to make choices about how you deduct the cost of large assets over time.
Now, here is the absolute critical thing to remember about any spend strategy. You always spend more cash than you save in taxes. It's not a dollar-for-dollar thing. A better way to think of it is as a discount on your spending, not as a way to make money. So the real goal here is to be intentional, to spend on things that also improve your business, your household finances, or your long-term plan.
Okay, moving on to our second strategy in the framework, donate. And as the name implies, this is all about giving money or property to qualified charitable organizations.
But it's not quite as simple as just writing a check and getting a deduction. Whether a charitable contribution is deductible actually depends on a whole bunch of things. You've got the type of donation, is it cash or property? The specific type of property matters. There are valuation rules to consider. Your own income level and its limitations come into play. And of course, you absolutely need the right substantiation. The receipts and appraisals.
So the key takeaway for donate is really this. Think of donations as voluntary wealth transfer decisions that might also come with a tax benefit. The deductions you get are very rarely dollar for dollar, and they're often limited by your income and the specific type of gift you make.
Our third category is defer. Deferral strategies are all about timing. They work in one of 2 ways. Either you postpone recognizing income into a future year, or you accelerate deductions into the current year.
So what does this look like in the real world? Well, common examples of defer strategies include things like contributions to traditional retirement accounts. That's the classic one. It also includes strategically timing when you recognize income, if your business allows for that flexibility, or timing when you pay for deductible expenses. It can even involve making certain accounting method choices.
And the crucial point here is that deferral is a powerful timing tool. It definitely reduces your tax bill in the current year, but, and this is a big but, it doesn't make the tax disappear forever. So while it can be incredibly effective, it absolutely needs to be coordinated carefully with your long-term income expectations and your overall retirement plan. And that brings us to our fourth and final category, shift. Shift strategies are all about changing who recognizes the income, where that income is recognized, or the tax rate that applies to it. This can mean shifting income within a family, across different business entities, and sometimes even across different states or jurisdictions.
So shifts strategies often involve things like family employment planning, for instance, hiring your children as long as the work is real and the pay is reasonable. It can also include things like compensation design, multi-entity planning, and state and local tax planning, like changing your residency when all the facts and circumstances support it.
Now, the key takeaway here is incredibly important, so listen closely. First, any kind of income shifting must follow economic reality. This is not just a paper exercise. It has to be properly documented and completely substantiated.
And this really gets to the heart of the shift strategy. Many of these approaches can be incredibly high value, but they are also, without a doubt, the most sensitive from a compliance standpoint. There are a ton of ways to shift income, but in practice, the right ones are always identified based on your specific situation, your business structure, and of course, your ultimate goals.
Okay, let's wrap this up with some guiding principles. It's so important to remember that tax planning works best when you treat it as a coordinated system, not just a random collection of isolated write-offs.
So, let's pull all this together. First, remember that tax savings are rarely dollar for dollar with what you spend or donate. Second, every single strategy has to have real economic substance and be properly documented. Third, the right plan for you is always tailored to your unique income, your business structure, and your long-term goals. And finally, the most powerful and effective planning combines multiple categories.
Which brings us to our final thought. The most effective planning often combines multiple SDDS categories. That's spend, donate, defer, and shift into one single coordinated plan. So the real question isn't just which strategy should I use, but how do they all work together for me? Please note that the information provided above is general in nature and does not constitute formal CPA advice. Since we have not entered into a signed engagement letter or formal advisory engagement with you, we encourage you to consult with a qualified professional to address your specific circumstances.